Hi, this is Dr. Bear. This video is going to be a brief introduction to financial statements. There are four main financial statements that we are going to be discussing. The income statement, the statement of retained earnings, which can also be called the statement of owner's equity, and the balance sheet are the three I'm going to be discussing today. The fourth one is the statement of cash flows, and we will cover that one in a later video all by itself because the statement of cash flows is a little more complicated and a little more in-depth. So again, today I'm going to introduce you first to these three. The income statement. Notice the format for an income statement and how it is labeled. It is for a period of time. It could be for the month ended, for the quarter ended, for the year ended, etc. But this statement is only going to track data for a specific period. Generally, it's going to be your fiscal year. You can present these broken down into smaller increments, such as a month or a quarter, but the income statement is going to track the income information for a company for the fiscal year. So the income statement presents your revenue and your expenditures. And if you've watched the previous videos and we discussed the accounting equation and we talked about revenues and expenditures just a little bit, but the income statement tracks how much money or revenue the company has earned for the year so far and all of the expenditures they have incurred for the year so far, and whether or not they currently have a net income or if they have a net loss. If revenues are more than expenses, you have a net income, but if expenses are higher than the revenues generated, you're going to have a net loss. The second statement is the statement of retained earnings, and I've got a couple of notes on here. I tell you to notice how your net income ties to your retained earnings statement. Again, the retained earnings statement is for the same time period as the income statement. You start with beginning retained earnings, and since this company has no beginning retained earnings, this tells me this is for the very first month of operations for this company. If there is no beginning retained earnings, they had no retained earnings from the prior period, then this is their very first month of operations. You take the retained earnings statement, you add any net income or subtract net loss if there's a loss that comes from your income statement. And if the owner has withdrawn any money from the business, you record those withdrawals here. When we talk about public corporation financial statements, instead of an owner withdrawing account, you will have a dividend account, but it works the same way. Dividends directly reduce your retained earnings. They are not expenditures of the company. Owner withdrawals or dividends paid to stockholders are not expenditures. They do not belong on the income statement. They are recorded on the statement of retained earnings as a direct reduction to your retained earnings. So after you add your net income and subtract out any dividends or owner withdrawals, you end up with the ending retained earnings balance. If you remember the accounting equation, we had assets equals liabilities plus equity, and I broke down for you in this other slide here how retained earnings are part of what makes up your equity. So if we look at the balance sheet, the first thing you'll notice about the balance sheet is it mirrors your accounting equation. It presents your assets, your liabilities, and your equity. But the difference in the balance sheet and the other two statements is the balance sheet is not for just a specific period of time. It is for as of the date that you run it. The balance sheet for a company begins on its very first day of operation. And at the point in time that you run the balance sheet, it holds all of the accumulated data for the entire life of the business. Just like the accounting equation, your assets on the balance sheet must be equal to the liabilities plus the equity added together. There's the balance of that accounting equation. And notice here where we've added in our retained earnings from the retained earnings statement onto this balance sheet. So again, if we go back up here, you notice that your net income flows into your retained earnings, and the retained earnings flows into the balance sheet. So when you are creating your financial statements, you have to create them in that same order. You have to know what your net income is before you can create your retained earnings statement. And you have to know what that ending retained earnings balance is before you can create your balance sheet. So there is a specific order to how these statements are created. And when you get down to it, everything ties to your balance sheet. The balance sheet is the main sheet that details the operations of the company. The retained earnings statement is only going to give you a detailed view of what is in that retained earnings number, and your net income is going to give you the detailed information as to what caused the changes to your retained earnings statement, except for the owner withdrawals or any dividends that may have been paid. Those are the things that are not on the income statement that are on the retained earnings statement that end up affecting retained earnings that ends up on your balance sheet. So in a later video, I'm going to go through actually capturing the economic activity and creating the transactions and how those get recorded that end up making up the data that goes into these financial statements. When we get to the statement of cash flows, what you will discover is the statement of cash flows is going to give you the detail of what caused the change in your cash balance from one period to the next. And it's broken down into 3 sections. You have your changes in cash flows related to operations, changes in cash flows related to investing activities, and changes in cash flows related to the financing activities of the business. So this is, again, it's just a brief introduction to the financial statements. The next video, I will actually start going through the process of how information is captured and recorded and how it ends up on these financial statements. So join me again for the next video. Subscribe to this channel so that you can get the updates as the videos are posted. And hopefully this information is very helpful for you.